So without further ado, I'm going to hand over to Tracy Crookston, who's going to give you an update or an overview of the concept of a public interest entity.
Thanks, Misha. Good morning, everyone. Well, today, as Misha said, I'm just going to set the scene as to what is a New Zealand Public Interest Entity, or PI. And the distinction between a PI and a non-PI entity is important when considering the independence requirements in Professional Engagement Standard 1, and it's also relevant to the topics that you're going to hear about today. So in New Zealand, a PI is an entity that meets the Tier 1 criteria in accordance with XRBA1 and is not eligible to report in accordance with the accounting requirements of another tier. XRBA1 is, of course, the application of the accounting standards framework. So what types of entities in New Zealand meet the definition of a public interest entity? Well, here are some examples. We have financial market conduct entities who are deemed by the FMA to have a higher level of public accountability. And these entities are sometimes referred to by the acronym FMC HLPA entities. Some examples of these types of entities are listed issuers, banks, insurers, credit unions, and the financial statements of managed investment schemes. Also included in the definition of PI are large for-profit public sector entities and large public benefit entities, for example, large charities. The size criteria to determine what is large in these cases is also set out in XRB A1. Due to recent IESBA revisions to the global PI definition in the IESBA code, the NZ-AUASB is currently working on an exposure draft which will provide a check-in on the existing New Zealand PI definition. This is to see whether it remains fit for purpose in light of the international changes. So please keep an eye out very soon for details of that in an assurance alert and on our website. I'll now pass you over to Misha, who will take you through recent developments in relation to non-assurance services.
Great, thank you, Tracy. So it's really timely to provide you all with an update on the developing non-assurance services standard. These changes to the code are really aimed at enhancing the independence standards, and they cover and clarify the circumstances in which firms may or may not provide a non-assurance service to an audit client. And these changes are really to reflect the current expectations with respect to auditor independence. So it's a really key topic. It's quite a hot topic, and you might have engaged with us over the past 6 months as we've consulted on this project. Before I get to an update on where we're at, I'll just give you a reminder of what the key changes in the global non-assurance standards services standard looks like. The key change really impacts on our PI clients. So it's those FMCs and the large entities that Tracy was talking about. The very fundamental key change here is that there is a new self-review threat prohibition for PI audit clients. So how this prohibition works is that if the provision of a non-assurance service might create a self-review threat, going forward, that service will be prohibited. What this means in plain English is if there is a 1% chance that the provision of a non-assurance service might create a self-review threat, it is prohibited going forward. So this sets a very robust and high bar, and it is expected that when these changes come into effect, the amount of non-assurance services provided to PI audit clients will significantly reduce. The other key change there is that materiality is no longer a factor in determining whether a self-review threat might be created. So that's the key changes for PIs. The other change for PIs is new requirements around communication with those charged with governance if the audit firm determines that a non-assurance service remains permissible. The changes aren't limited to your audit clients that are public interest entities. There's something in here for all audits. So there are clarifications to assist in the application of the conceptual framework to assist all audit firms identify, evaluate, and address threats to independence created by providing a non-assurance service. So that's a very high level overview of the key changes that are coming through internationally. Now let's work through what's been happening in New Zealand. So last year, the XRB issued an exposure draft proposing to adopt those revised provisions. But in addition to the self-review threat prohibition, we proposed an additional New Zealand-specific prohibition on the provision of tax planning and tax advisory services to public interest entity clients. The reason for this was that the global position actually has a limited carve-out from the self-review threat prohibition for the provision of tax planning and tax advisory services. We thank you all very much for those of you who participated in our outreach last year, and also to those of you who wrote really detailed and helpful submissions to inform the way forward. What we heard was a wide range of views. So we heard support for this prohibition from our regulator and from the public sector, but we also heard significant concerns for unintended consequences, especially from our practitioners. So we have undertaken extensive additional outreach subsequent to our December consideration of the submissions that we've received. And breaking news, I can update you on the IESBA board meeting that happened last week. And so what our next steps are going to be in this space is that the IESBA agreed not to proceed to prohibit tax planning and advisory services for PIs in all instances. Rather, they agreed with a revised recommended way forward. So what that revised NZ position will look like will include two New Zealand paragraphs. The first will be to clarify the intent of the likely to prevail test. So as I mentioned on the last slide, the global position has a carve-out for the provision of tax planning and advisory services in limited circumstances. And that carve-out uses this wording, likely to prevail. So we are looking to propose to add clarification that the intent of this likely to prevail test is a high threshold, and this is to reduce the risk of subjectivity and to support consistent application of this threshold. In addition, the board has agreed to include a New Zealand documentation requirement to require the audit firms to document their judgments in evaluating that this likely to prevail test has been met. So this was only agreed in principle last week, and we will be doing targeted and limited consultation with an aim to approve the standard in June. So thank you again for all of you who have contributed and fed back your views on this very important topic. We will be undertaking and seeking further views from you on this recommended and alternate way forward. Next, I want to pass to Sharon, and she will talk about revisions to the fees standard. Before I do that, I'll just highlight that the non-assurance services standard and the fee revisions were developed in conjunction, and they will work together to raise the independent standards. Both the non-assurance standard services and the fee standard will become effective from December 2022, and we will aim to get the NAS standard issued in due course to allow time for implementation and adoption. But Sharon will walk you through the fee standard, which we've actually already issued. Thanks, Sharon.
Just need to unmute there. So thank you, Misha, and good morning, everyone. I'll take you through a few of the key changes to the fees provisions in the code. So as Misha mentioned, this standard has already been issued. It was issued March 2022, and it amends the Professional and Ethical Standard 1. So in Part 4A, Section 410 of the code is replaced, and in Part 4B, Section 905 is replaced. And those are the fees provisions that relate to audit and review engagements in Part 4A and to other assurance in Part 4B. There were also some conforming and consequential amendments to a few of the other sections in the code. The revisions become effective from December this year. My focus on this session is on the more significant changes in the code, but I would encourage you all to take a look at the amending standard, which is available on the XRB website. So the key features of the revisions, these include the premise that there is an inherent self-interest threat to independence created when fees are negotiated with and paid by the audit client. There are enhanced provisions regarding fee dependency for all audit clients. There's a new requirement for the firm to cease to be the auditor for a public interest entity audit client if circumstances of fee dependency continue beyond a certain period. And there's enhanced transparency regarding fee-related information for PI audit clients to those charged with governance. So the revised provisions are premised on the basis that there is an inherent self-interest threat to independence that is created when fees are negotiated with and paid for by the audit client. So fees for assurance services are usually negotiated with and paid by an audit client, and this practice is generally recognised and accepted by intended users of the financial statements. But as the revisions in the code acknowledge, this creates an inherent self-interest threat to independence, and it might also create an intimidation threat. So the code provides a robust list of factors that are relevant in evaluating the level of threats created when fees for an audit or any other engagement are paid by the audit client, and it provides examples of safeguards that might address those threats. The code also requires that the firm not allow the audit fees to be influenced by the provision of services other than audit to an audit client by the firm or a network firm. So there are many factors that go into determining the audit fee. Under the code, the provision of other services to an audit client is not a factor that should influence the level of the audit fee. The code does permit the firm to take into consideration any cost savings that might be achieved as a result of experience derived from the provision of other services or of services other than audit to the audit client. So, Misha, if you could move to the next slide, please. The provisions regarding fee dependency for all audit clients have been enhanced. When the fees generated by a firm from an audit client represent a large proportion of the revenue of one partner or one office of the firm, a self-interest or intimidation threat might be created. For non-PI audit clients, when the total fees from an audit client represent more than 30% of total fees received by the firm for 5 consecutive years, as a safeguard to the threat to independence, the firm is required to have either a pre-issuance or a post-issuance review performed by an assurance practitioner who is not a member of the firm expressing the opinion on the financial statements. And if the fees for the audit client continue to exceed 30%, then the pre-issuance review or post-issuance review needs to continue. In the PI audit client space, when the total fees from an audit client represent more than 15% of total fees received by the firm for 2 consecutive years, as a safeguard to the threats to independence, and prior to the issuance of the audit opinion on the second year's financial statements, the firm is required to have a review which is consistent with an engagement quality review performed by an assurance practitioner who is not a member of the firm expressing the opinion on the financial statements. If the fees continue to exceed 15% of total fees of the firm for 5 consecutive years, then the firm is required to cease to be the auditor after the audit report is issued on the 5th year. There is an exception, and that is if there is a compelling reason having regard to the public interest and provided that a regulatory or professional body concurs that it is in the public interest for the firm to continue as auditor, and then the firm engage an assurance practitioner who is not a member of the firm expressing the opinion to perform a pre-issuance review. So that exception is expected to come in only in very limited circumstances. Next slide, please, Misha. Communication by the firm of fee-related information with those charged with governance assists in their assessment of the firm's independence. And so the IESBA board has enhanced the provisions around the communications or the required communications with those charged with governance. The new provisions require that the firm communicate with those charged with governance of an audit client that is a PI. So again, these apply only to the PI entities in a timely manner. And the information that must be communicated include the fees paid or payable to the firm or network firms for the audit of the financial statements, fees other than for the audit of the financial statements that are charged to the audit client for the provision of services by the firm or network firm during the period covered by the financial statement, and whether the threats created by the level of those fees are at an acceptable level. And if they are not, any actions the firm has taken or proposes to take to reduce the threats to an acceptable level. The objective of the communication is to provide the background and context to the fees for the audit and for other services to enable those charged with governance to consider the independence of the firm. Where there is a fee dependency, so where the fees from the PI audit client exceed 15% of total fees received by the firm, then the firm is also required to communicate this with those charged with governance and whether this situation is likely to continue. The firm is required to communicate safeguards applied to address any threats that were created, including the performance of a pre-issuance review and whether the firm proposes to continue as the auditor of the PI entity. The enhanced transparency serves to better inform views and decisions of those charged with governance and a wide range of stakeholders about the audit firm's independence. So the code also requires public disclosure of fee-related information for PI audit clients by the audit firm when the entity itself does not disclose that information. So in New Zealand, we have the accounting standards and for companies legislation which require disclosure of fees paid to the audit firm. I'd just like to add here that the New Zealand Accounting Standards Board is undertaking a project to consider amendments to the disclosure of audit firm remuneration in its standards and looking at the categories of disclosures. So I'll now pass on to Anna, who will take you through the technology section of the webinar.
Thank you, Sharon. Good morning, everyone. My name is Anna Herlander, and I am project manager at XRB. And I'm going to present some proposed technology-related revisions to the Code of Ethics. The IESBA, International Ethics Standards Board for Accountants, issued exposure draft in February and is seeking feedback to the proposed revisions until 20th of June. Here in New Zealand, we proposed the consultation period that ends on 9th of May, and it will help us to develop a submission that we would like to provide to the IESBA. The aim of the proposed revisions to the Code of Ethics is to enhance robustness of the code and expand its relevance in our environment that is currently constantly shaped by changes in technological solutions. The term technology that is used in the code is very broad, and it is by purpose, so it can encompass any any possible current and future not yet known technology solutions. The proposed changes to the exposure draft the proposed changes to the code relate to many different parts of the code, and some of them are linked directly to technology, like reliance on the output of technology, ethical threats resulting from use of technology, or auditor independence when providing technology-related services. However, there are other proposed revisions to the code that are very relevant when technology is used, but they are also relevant when technology is not directly involved. So this proposed changes relate to confidentiality of information and data governance process, complex circumstances, competence, and ethical leadership of professional accountants. Today, due to time constraints, I will present only some revisions to the code, and during my presentation I will also ask your views about on the proposed changes, and we will use polling to ask to check what are your views about the changes. The first area that I wanted to talk about is ethical threats resulting from the use of the technology. Use of technology is not considered a separate threat, but is considered a specific circumstance that might create threats to compliance with the fundamental principles. Therefore, the IESBA proposes several considerations that professional accountants should think when they identify threats. And on this slide, I copied paste exactly from the exposure draft the proposed considerations. They include to consider if the professional accountant has information available how the technology function, whether technology is appropriate for the purpose, whether the accountant has the professional competence to understand the technology and explain the output from the technology, whether technology incorporates expertise or judgments of the accountant or the employing organization, and whether technology was designed or developed by the accountant or employing organization, and therefore might create a self-interest or self-review threat. So now I would like to ask you, what do you think about these proposed considerations? Do you support that these considerations are included in the Code of Ethics to guide the accountants when they identify threats? So please click yes, no, or uncertain. And if you have any further comments, you can also use chat to provide any additional thoughts. So I think we started poll now, but I can't really see how many people answered the poll. So I think Misha is monitoring this, and once we have majority of people votes, so we will just have a look at the results.
Yeah, and I'm monitoring that, and there's a few more votes coming through, so we'll give it a couple more seconds, and then I'll close it off.
And here we have the results. So 68% support the considerations relating to identifying threats, and 32% is uncertain. And that's okay. It's it's really helpful feedback, and I just wanted to encourage you when you are uncertain and you want to provide any more comments. So while you are uncertain, please do this in the chat box. I will now discuss the next issue, which is relying on the technology. Professional accountants should consider if they can rely on the output of the technology in a similar manner as when they rely on the work of others. So the current code of ethics includes specific section what professional accountants should do when they want to rely on the work of others, or professional accountants in practice when they want to rely on the external experts. And now the IESBA proposes specific factors that should be considered if professional accountant would like to rely on the output of technology in a similar manner as on the output of work of others. So proposed factors include the nature of the activity that will be performed by the technology, expected use or the output from the technology, professional accountants' ability to understand the output, whether technology is established and effective for the purpose intended, whether it was appropriately tested and evaluated, the reputation of the developer of the technology, the employing organization's oversight of the whole cycle of use of technology, starting from design through implementation, operation, maintenance, and updating of the technology, and the appropriateness of the inputs to the technology, including data and any related decisions. So now I would like to ask you a question again. Do you think these factors are reasonable? Do you support that they are included in the code of ethics to guide professional accountants what they should consider when they want to rely on the technology? And here we have the results. 71% says yes, no one says no, and again, about 30% are uncertain. Thank you very much for this feedback. I would like to talk now about complex circumstances. This is one of those changes to the code that the wording is not exactly linked to technology. However, it is very relevant to consider complex circumstances when technology is involved. The proposed revisions acknowledge existence of complex circumstances and provides factors that professional accountants could consider when they manage complex circumstances. So the first application material, proposed application material includes this acknowledgement, and here again it's just exact text from the exposure draft that some professional activities might involve complex circumstances that increase the challenges when identifying, evaluating, and addressing threats to compliance with the fundamental principles. The second application material includes more specific explanation what is complex circumstances. So complex circumstances arise when facts and circumstances involve elements that are uncertain. There are multiple variables and assumptions which are interconnected or interdependent, and they might also change quite rapidly. So the third application paragraph proposes actions, what professional accountants could do to mitigate the challenges arising from complex circumstances. And this might involve consulting with others, using technology to analyze relevant data, making relevant stakeholders aware of the inherent uncertainties or difficulties, or monitoring and any developments and assessing whether they might impact any judgments made by professional accountant. And now I have another question to you. What do you think about these proposed changes? Do you support the acknowledgement of complex circumstances to be included in the Code of Ethics? And is the application material, especially these bullet points, how to mitigate challenges from complex circumstances? Is it helpful guidance for the accountants? And here we have the results. So 60% of those who voted support the acknowledgement of complex circumstances in the code, and 57% think that this material is helpful. 3% doesn't support and think it's not helpful, and 37% and 40% are uncertain. Again, if you are uncertain or if you do not support, you are more than welcome to leave some comments in QA or in chat box, or whatever suits you better, and then we can consider your feedback and your specific considerations when we develop our submission on this exposure draft. So the next item I wanted to present is IT system services. This part of the revisions is in the part of Code of Ethics that relates to independence of the auditors. So it's quite specific to circumstances when auditors provide services to their audit clients. The IESBA proposes to expand the description of IT system services to capture the widest possible IT system services set that currently exist. You will see on the next slide the current description that is in the code. So it does that IT systems include design and implementation of hardware or software systems, while the new proposed description includes is much more detailed and tries to capture everything that is related to IT systems. So designing or developing, implementing IT systems, operating and maintaining, monitoring, updating, and collecting or storing data. The IESBA, after increasing the description of IT system services, identified those services that assume management responsibility. The Code of Ethics prohibits to provide any services to audit clients that might, any services that that assume management responsibility. Therefore, by identifying examples of this IT system services, it implies that these services will be prohibited to provide to audit clients. And they include hosting of audit clients' data and operating audit clients' network security, business continuity, or disaster recovery function. There is also explanation in the exposure draft that I didn't put on this slide that the hosting of audit clients' data is allowed if it is for the purpose of providing permissible service. So my take on this is that nowadays almost all auditors ask their clients to provide information and drop into specific software that is managed by the auditor, and this is only for the purpose of audit or providing any other service. So if the data is hosted by the auditor for this purpose, just for performing the service, then this is allowed, and it does not assume management responsibility. So I think now will be the next question. Do you support the examples of IT system services that assume management responsibility? Let's have a look at the results. 73% of people who voted do support these examples. 6% don't, and 21% is uncertain. Thank you very much for your feedback on this. And now I would like to present you some more IT system services. Now these ones that might create a self-review thread. As Misha explained earlier, the new revisions that relate to independence of the auditor say that if there is a chance that services might create self-review thread, they are prohibited for public interest entity audit clients. So therefore, by identifying these examples of IT system services that might create self-review thread, the code would imply that they will be prohibited for PI audit clients. And on this slide, we have these examples. So when the services form or affect audit clients' accounting records or system of internal control over financial reporting, they might create a self-review thread if they are designing, developing, implementing, operating, and maintaining, monitoring, or updating IT systems, supporting and audit clients' IT systems, or when implementing accounting or financial information reporting software. So what do you think about these examples? Do you think that they might create self-review threat and therefore they should be prohibited for PI audit clients? All right, and 66% support the examples. Some 3% don't, and 31% is still is uncertain about this. And again, I encourage you to share your views. Why do you think it's there is why are you uncertain? Is there anything specific that might require further explanation in the code, for example? So the next subject that I would like to discuss is applicability of NES requirements when technology is involved. So this was quite important for the IESBA to include more clarification to the code that whenever a firm considers to provide non-assurance services that involve technology, or whenever technology is sold, resold, or licensed to an audit client, then the requirements that are included in section 600 of the code need to be considered. And these requirements in section 600 relate to independence of the auditor when they provide non-assurance services. On the next slide, there are extracts from the exposure draft, and you can see that that there is proposal for 2 paragraphs, one in section 500 and one in 600, that explicitly say that whenever technology is involved or whenever a firm provides, sells, resells, or license technology, then the requirements of section 600 needs to be considered. So please let us know what you think about these proposed changes. Do you support that they are included in the code? And the results are coming. 59% yes, and 41% is uncertain. Thank you very much. I think it's good to see that for many proposed revisions, about 60% of those who vote support the changes. And again, it would be interesting to see for those who are uncertain the reason why and what could be improved in the proposed revisions. So now I will talk about close business relationships examples. The IESBA proposes to revise this close business relationship examples in conjunction with the NES requirements when technology is involved. It's by doing this, the code of ethics would be more aligned and consistent, and similar wording that is in the proposed paragraphs that relate to NES will be also in the examples of close business relationship. However, what is interesting, when we look at these examples, you can see that they do not relate directly to technology. They could be they could be applied in technology related situations, but they could be applied in other situations as well. And I put here in bold font the proposed changes. So in the first example of close business relationship, the IESBA proposes to fine-tune the wording to make it more relevant nowadays and more obvious in technology-related situations. So when a firm sells, resells, distributes, or markets the client's products or services, or when the clients do the same with the firm's services. And another new close business relationship example is when firm and the client jointly develop a product or service. The IESBA was considering thinking if there are any other examples that should be included in close business relationship that would guide professional accountants when technology is involved, to guide them that this might be a close business relationship. However, it proved to be quite difficult to provide other examples that would not require complex, specific description of detailed arrangements. So on conclusion, it seems that any type of technology-related arrangement that would be close business relationship is probably captured by these general examples. This one proposed that are here on the slide, but also any other close business relationships that are already in the code. So the IESBA is specifically interested in feedback on this close business relationships, and we also wanted to ask you what you think about these examples. Do you support these examples, and do you think it's fine that no other examples are developed because they would be too complicated and very specific? And let's have a look at the results. 67% yes, and 33% uncertain about examples, and 43% supports that no further examples are developed, 70 no, and 40% uncertain. Yes, this is quite interesting feedback, and I can imagine that probably there could be some other examples or some that would be useful for professional accountants. But I think it's important that we could hear from you. We could hear especially from the practitioners, from those who are close business relationships, if you would be able to provide any feedback about any business relationships that worry you, or you think it would be really useful to include those examples in the code. I think this was the last issue that I wanted to talk in detail. Now I will just let you know briefly about any other proposals to the code, and I included also paragraphs when you can find these proposed changes in the exposure draft. So there is proposal to explain that professional accountants should maintain confidentiality of information acquired during the performing professional activity, and prompt professional accountant to secure this information in the whole cycle of data governance. There is another proposal that expands professional competency of accountants to include soft skills. Proposal to emphasize that professional accountants should demonstrate ethical behavior. And on the next slide, I will have some more proposals. There is also a proposal to define a little bit better what automated accounting and bookkeeping services are, and especially what is routine or mechanical. And finally, there is a clear statement, explicit statement, that independence provisions of the code, when they are applied to assurance engagements, they also apply to engagements on non-financial information, for example, ESG, and including also greenhouse gas statements. I really encourage you to go to the exposure draft and read this proposed changes, and please let us know what you think, because any feedback from you will help us to develop our New Zealand submission to the IESBA. Thank you very much for your attention. This is the end of my presentation, and now I will pass to Lisa, and she will present you revisions relating to engagement, team definition, and group audits. Thank you.
Great, thank you, Anna. Yes, hello, I'm Lisa Thomas, and I'm going to take you through some of the proposals of the second exposure draft we're looking at today, which deals with the revisions to the code relating to the definition of engagement team and group audits. So IESBA were pretty busy while we were on the beach this summer, because like the last exposure draft, this one was actually issued in February as well. And if you'd like to comment directly to IESBA on the exposure draft, the comment period for the ED is going to end on the 31st of May. Otherwise, we'd love to hear your comments here at the XRB to help inform our submission. And so we ask, if you do that, you send them through to us before the 16th of May. The objectives of the project are twofold. The first one is to align the definition of the term engagement team in the code with the revised definition of the same term in ISA 220 revised, which is quality management for an audit of financial statements. And secondly, to revise the international independence standards so they are robust, comprehensive, and clear when applied in a group audit context. So firstly, looking at the revised definitions, and we'll start off with engagement teams. So this is to align the code to the expanded definition of engagement team in ISA 220 revised, to include individuals that perform procedures on the engagement, regardless of their location and employment status. So this will mean component auditors outside of the firm or its network are therefore going to be considered part of the engagement team. Moving on to engagement quality reviewers, they can be sourced from within or outside the firm or its network. Therefore, IESBA believes that the EQRs, whose independence plays a vital role in promoting audit quality, should be subject to the same independence requirements, regardless of whether they come from within or outside the firm and its network. And this is going to be consistent with PS4. So in light of these changes, other definitions such as audit team have also been updated, as they include the engagement team definition and the EQR within their definition. In addition to these definition changes, there's also application guidance in the ED that is proposed to clarify the roles of experts used in an audit and whether they would or wouldn't be considered part of the engagement team or audit team. So as I outlined earlier, the other main objective of the ED is to provide clear guidance on independence requirements in a group context. The IESBA felt it was important to clarify the independence requirements referred to in ISO 600 revised by having an explicit link in the code. And with the change in definition of engagement teams, the IESBA is proposing changes to the code to make it clear the independence requirements for the various individuals who are now part of the revised definition, and for component auditors outside of the firm that are also now part of the revised definition. So what they're doing is proposing a new section in the code called group audits, and this will be found at section 405 that addresses the relevant independence considerations that apply in a group audit and the independence requirements referred to in ISO 600 revised. So if we firstly look at the individual's independence requirements, so individuals in a non-network firm will be subject to the same requirements as those within the network. So this will align with the revised engagement team definition in ISO 220 that treats all individuals performing procedures the same, as IESBA is wanting to eliminate any perception that independence of individuals of the engagement team outside of the group audit firm and its network is less important than those within the group audit firm and its network. Firm independence. So within the network, there's no change for group auditors and component auditors within the auditor's network, as the code already requires them to be independent of the audit client. However, this has been made more explicit in the new section 405. For CA firms outside of the network, the CA firm needs to be independent of the component audit client. And as you'll be aware, this is consistent with Part 4A that applies to all firms and its audit clients. The component audit firm, however, needs to follow the PI or the non-PI independence provisions of the group audit client. So we'll take a look a bit closer at that on this next slide. So this diagram comes straight from the exposure draft, and it shows that regardless of whether the component audit client is a PI or a non-PI, it is the PI status of the group that drives the independence requirement provisions that are applied to the component audit firm in relation to the component audit client for the purposes of the group audit. The conceptual framework will then should apply with respect to any other related entities of the component audit client. I'll just give you a wee minute to have a look at that diagram so that soaks in. And now I'd be interested in getting your feedback on these proposals. So I'd like to know, do you agree with the proposal that the component auditor follows the PI independence provisions of the group audit client for the purpose of the group audit? Yes, no, or uncertain? Okay, thank you for everyone for voting. So we've got 75% at yes and 25% at uncertain. So thank you for that. Like Anna's presentation, those who voted uncertain, if you would like to add a bit more context around your vote in the chat, please feel free to do so. Okay, next slide, please, Misha. Thank you. So moving on to some specific areas, firstly, we're going to look at financial interest. So financial interest, there's a prohibition on non-network component audit firms from holding a direct or material indirect financial interest in the entity whose group financial statements the group auditor firm is expressing an opinion on. And there's no consideration of materiality of the component audit client to the group audit client. So this is consistent with the approach in the extent standard section 510 and on a group audit firm and its network firms from holding a direct or material indirect financial interest in the group audit client. The prohibition, however, doesn't apply to other entities within the group, such as the intermediary holding entity, and the conceptual framework would be applied in this instance. With loans and guarantees, the prohibitions in section 511, which deals with loans and guarantees, is to apply to non-network firms for group audit clients the group audit firm is expressing an opinion on. So again, this is not extended to intermediary holding entity or any other related entities of the group audit client, and instead you'd apply the conceptual framework to that. Non-assurance services. So given the substantive revisions to non-assurance services, IESBA thought it'd be good to clarify the application for a group audit. So in the first instance, IESBA is proposing to make it clear that if a group audit client is a PI, then the independent requirements for the NAS provided by a non-network firm to the component audit client are those applicable to PIs, regardless if the component audit client is a non-PI. So you'll realise this is consistent with that overarching principle we just discussed a couple of slides back regarding the independence requirements for PIs and non-PIs. In addition, IESBA felt it was important to provide application material around self-review for when a non-network component audit firm performed limited scope work for the purposes of the group audit. For example, a specific line item such as inventory. In this circumstance, the reference point for the evaluation of the self-review threat is the specific line item such as inventory. Any other financial information of the component audit client is not relevant. It is not subject to any audit work. So let's take a look at this guidance. I'll give you a minute to read it. So on the first slide here, we've got the example. And if we move on to the next slide, there's the explanatory guidance for the self-review threat. So I'll give you a minute to read that one as well. So the reason I've given you time to have a good read of this is because I'd like your opinion on this guidance. So if we jump to the poll question, do you think this proposed guidance is sufficiently clear and appropriate to describe the NAS requirements? Yes, no, or uncertain. Okay, we've got mixed views this time. We've got 52% say yes, 16% say no, and 32% are uncertain. You'll know the drill. You've heard this a few times today. Please feel free to add any comments in the chat for those people who have voted no or uncertain, as getting an understanding of that view will help us do our submission on your behalf. So as you'll appreciate, we don't have time to cover all aspects of the exposure draft today. So I just wanted to point out that in the exposure draft, they're also proposing guidance based around extent provisions of the code, which explains that a threat to the component auditor firm's independence might be created by a financial or business relationship of the component audit firm with the component audit client during or after the period covered by the group financial statements, but before the component audit firm agrees to perform the audit work, or by previous services provided to the component audit client by the component audit firm. So as you can appreciate with the application guidance, there was a lot of wording there, but so I thought I'd encourage you to actually go and have a read of that in your own time. So moving on to the final topic of the morning, a breach of independence. Well done, team, you're nearly at the end. So firstly, looking at the group audit firm level, if there's a breach identified at the group audit firm level, then you follow the process in the extent code, which is shown in Appendix 1 of the exposure draft document. There's new guidance, however, proposed in Section 405 for when a breach occurs at the component audit firm level. If the component audit firm is within the network, a breach by independence by a network firm is effectively the same process if the breach is by the firm, and so needs to be dealt with in the same way, given the requirement for a network firm to be independent of audit clients of other firms within the network. To make the linkage to the process to follow in the exempt code in the context of group audit, IESBA is proposing that if a component audit firm within the group audit network concludes a breach of Section 405 has occurred, that the component audit firm first communicate the breach immediately to the group engagement partner. The group engagement partner is then required to assess the breach and determine the appropriate actions to take in accordance with the extent provisions of the code when dealing with breaches. Looking at a non-network component audit firm, IESBA are really cautious not to imply that if there was a breach of independence by an individual at a component level, then the group audit would not automatically be able to express an opinion on the group financial statements. Instead, careful consideration of the facts and the circumstances is required, particularly around the principle of objectivity. If there is a breach at a non-network component audit firm, then the proposal is broadly similar to the principles to the process in the extent code. Section 405 proposes that the component audit firm takes a number of actions, including communicating with the group engagement partner with significance of the breach and actions. And then the group engagement partner is to assess the breach, focusing on the component audit firm's objectivity and whether the group audit firm can use the work of the component audit firm for the group audit. Guidance is proposed in 405 that is consistent with ISO 600 revised when a breach can't satisfactorily be addressed and other means need to be used to obtain evidence. Consistent with the provisions in the extent code for dealing with breaches, IESBA is proposing that the breach is communicated to those charged with governance of the group client, including significance of the breach, actions proposed or taken to satisfactorily address the consequences of the breach. If those charged with governance don't concur, then the code actually prohibits the group audit firm from using the component audit firm's work. Give you a second just to read that slide to let it soak in a wee bit. And then we'll move on to the last poll for the morning. Okay, do you agree with the proposals to address a breach of independence by a component audit firm? Yes, no, or uncertain. If you'd like to cast your last vote for the day. Okay, 68% of you yes and 32% uncertain. Again, if those uncertain, if you'd like to add a little bit more, please feel free to do so. Otherwise, that's all from me this morning. And so now I'll pass you over to Misha to wrap things up.
So thank you very, very much on behalf of the XRB, to all of you for your attendance and participation, especially in our polls today. It's been really helpful to us to get those sort of indicative views, and we do encourage you to reach out and provide some more thoughts as you sort of explore this area in any more detail. This time we do have a little bit of time left, so if you do have any questions for any of the team, please do pop those into the Q&A in the webinar function, and we'll do our best to answer any questions that you might have. And while you're thinking of some questions, I'll just let you know that, as you would have seen, today's webinar has been recorded, so it will be made available on the XRB website in due course, as well as the slides. So if you're wanting a copy of today's slides, we will make available, we'll put those up on our website, and we will send out some communications so you are able to find them and download them if you wish. So yeah, I'll just give you a couple more minutes if anyone does have any questions for any of the team. I've got some good comments in the chat, so I'm looking forward to reading those when I'm not sort of focused so much on controlling the slides. I think there's some good feedback we've got in there as well. So yeah, at this stage, I think we'll let you get on with your morning. And again, on behalf of the XRB, would very, very much like to thank you all for your participation today, and we look forward to seeing any other thoughts that you might have. So please do reach out to the team if you have any questions or thoughts. Thank you and enjoy your day.